Assalamualaikum and very good morning. My name is Muhammad Zahari bin Arawi. My metric number is 304362. So this presentation aims to analyze the financial performance of Prime Guide Industrial Solutions Sdn Bhd through a cost volume profit CVP analysis approach. So the Prime Guide is a company specializing in the manufacturing of advanced industrial safety helmet called Guardian Shield helmet, which includes smart sensor for real-time hazard detection. So in 2024, the company sold 75,000 unit and is now facing rising competition, inflation and cost pressure. So we go to the next part. The importance of CVP analysis. Number one is help in profit planning. CVP analysis show how change in cost, selling price and sale volume affect a company profit. It help business set sell target and determine how many unit need to be sold to achieve desired income. Number two is identify break-even point. CVP calculate the break-even point, which is the level of sale where total revenue equal total cost. So we call it no profit or loss. This is crucial for knowing the minimum performance needed to avoid losses. So number three is support decision making. Manager use CVP to evaluate the impact of different business decisions, such as changing selling price, increasing marketing expense, adjusting production volume, and introducing product. And lastly is cost control and budgeting. It helps in separating fixed costs and variable costs, which is improve budgeting and cost management. Business can monitor which is cost increase with production and which stay the same. Thank you. Our objective in this presentation is to provide an in-depth analysis using CVP technique to help Prime Guide plan for 2025. Objective number one is reconstruct the 2024 income statement. Number two is calculate important CVP metric. Number three is analyze 5 different strategic scenario for the upcoming year. And lastly is recommend the most effective strategy to improve profitability and competitiveness. Question number one in part A is reproduce an income statement for the year and 31 December 2024 for Prime Guide Industrial Solution Sdn Bhd by showing the sale, total variable cost, total fixed cost and net profit. As you can see at my left, there is our income statement for the year and 31 December 2024 for Prime Guide Industrial Solutions Sdn Bhd by showing the sale, total variable cost, total fixed cost and net profit. So in this part, I will explain about our sale and variable cost. Number one is sale commission is paid to selling engineers commission, which is 2% of total sale. Total sale 1,875,000 ringgit. Commission 2% multiply 1,875,000 equal 225,000 ringgit. This is also considered a variable cost because it changes according to the sale volume. To get total variable cost, we need to plus variable production cost plus sale commission. 937,500 plus 235,000. We get 1,162,500. So we go to the variable cost. Variable costs are cost that change directly with the number of units produced or sold. In this case, the cost increase as more Prime Guide helmet are produced and sold. So there are two main components of variable cost in this case. One is variable production cost. It is the cost of raw material and direct labor to produce one ton, given in the financial statement. 937,500 ringgit for 75,000 units. This show the production cost per unit is 937,500 divide 75,000 units. We get 1550 RM per unit. Thank you. In this part, I will tell about a fixed cost in our CVP analysis. Fixed costs are costs that do not change even if the total number of units of production or sale increase or decrease. They remain constant in the short run. Number one is fixed manufacturing overhead, RM 180,000, for example, machine maintenance or depreciation. Number two is digital marketing, RM 52,500. It does not change according to the number of units sold. Number three is website maintenance, RM 80,000. Number four is factory rental, RM 45,000. Number five is administrative salary, RM 90,000. Number six is utility and insurance, RM 22,500. So After combine it, we get a total fixed cost, which is RM 270,000.
Question 2. Determine each of the following items for the year 2024. Show the formula and calculation. A. Sales price per unit of the product. Total sales divides unit sold. 1,875,000 ringgit divides 75,000 units equal 25 ringgit. B. Total variable cost. Cost of goods sold variable plus sales commission. 937,000 ringgit production plus 225,000 ringgit commission equals 1,162,500 ringgit. C. Variable cost per unit. Total variable cost divide unit sold. 1,162,500 ringgit divided 75,000 units equal 15 ringgit 50 cents. D. Variable cost. COGS to sales price ratio. Variable production cost divide total sales. 937,500 ringgit divide 1,875,000 ringgit equals 50%. E. Total fixed cost. Fixed manufacturing overhead plus digital marketing plus website maintenance plus factory rental plus administrative salaries plus utility insurance. 188,000 ringgit plus 52,500 plus 15,000 plus 45,000 plus 90,000 plus 22,500 equals 405,000 ringgit. F. Contribution margin per unit. Selling price minus variable cost per unit. 25 minus 15 ringgit 50 cents equal 9 ringgit 50 cents. G. Contribution margin ratio. Contribution margin per unit divide selling price. 9 ringgit 50 cents divide 25 ringgit equals 0.38 or 38%. H. Break even point BEP in the unit. Total fixed cost divide contribution margin per unit. 405,000 ringgit divide 9 ringgit 50 cents equal 42,632 units. I. Break even point BEP in amount RM rounded to 2 decimal points. Break even point units multiply selling price. 28,421 multiply 25 equals 1,065,800 ringgit. J. Net income to sales ratio. Net profit divide sales revenue. 307,500 ringgit divide 1,875,000 ringgit equals 16.4%. Scenario 1. Prime Guard wants to achieve a 28% net income to sales ratio in 2025. First, selling price 25 ringgit. 2. New production cost. 2024 cost equal 12 ringgit 15 cent. 4% increase equal 15 cent. New equals 13 ringgit. 3. Sales commission 12% equal 3 ringgit. 4. New variable cost per unit equal 13 ringgit plus 3 ringgit equal 16 ringgit. 5. Contribution margin per unit equal 25 ringgit minus 16 ringgit equal 9 ringgit. 6. Fixed cost equal 405,000 ringgit. First, X equals units to sale. Second, total sales equal 25 ringgit X. 3. Net income equals 28% of 25 ringgit X equal 7 ringgit X. The profit formula is 25 ringgit X minus 16 ringgit X minus 405,000 ringgit equal 7 ringgit X 2X equal 405,000 X equal 405,000 divide 2. The answer is X equal 2,500. Total sales equal 2,500 multiply 25 ringgit the equal 5,062,500 ringgit. Prime Guard must sell 202,500 units or 5,062,500 ringgit to achieve a 28% net income ratio.
So in this scenario 2, we want find a new price. So the new price we change element P in this formula. So let's use this formula. Sales minus variable cost minus fixed cost equal to net income. 75,000 ringgit P minus 75,000 ringgit times to 30 ringgit plus 12% P minus 405,000 ringgit equal to 21,000 ringgit. P is equal to 30 ringgit and 67 cent. The calculation is to achieve 28% profit without more sales, price must increase to 30 ringgit 67 cents per unit. The risk of this strategy is the current price 25 ringgit is already higher than competitors, and rising price to 30 ringgit and 67 cents may reduce customer demand. In the competitive market, customer might choose cheaper alternative, and this could lead to lower actual sales than expected. Calculation for scenario 3. Sales revenue is 150,000 ringgit times to 28 ringgit equal to 4,200,000 ringgit. Variable cost is 150,000 ringgit times to 16 and 12 equal to 2,480,000 ringgit. Sale commission is 4,200,000 ringgit times to 16% equal to 672,000 ringgit. Total variable cost is 2,418,000 ringgit plus 672,000 ringgit equal to 3,090,000 ringgit. Contribution margin is 4,200,000 ringgit minus 3,090,000 ringgit equal to 1,110,000 ringgit. Fixed cost is 283,500 ringgit. Net income is 1,110,000 ringgit equal minus 283,500 ringgit equal to 826,500 ringgit. Net income to sale ratio 826,500 ringgit divided by 4,200,000 ringgit equal to 0.197 and 0.197 times to 100 equal to 90.7%. So the answer for scenario 3 is net income to sale ratio is 19.7%. Still below the 28% target but much improved. Calculation for scenario 4. Sale revenue is 187,500 ringgit times to 25 ringgit equal to 4,687,500 ringgit. Variable cost is 57% times to 4,687,500 ringgit equal to 2,672,875 ringgit. Sale commission is 4,687,500 ringgit times to 12% equal to 560,500 ringgit. Total variable cost is 2,672,875 ringgit plus 562,500 ringgit equal to 3,235,375 ringgit. Contribution margin is 4,687,500 ringgit minus 3,235,375 ringgit equal to 1,452,125 ringgit. Fixed cost is original fees equal to 405,000 ringgit. Replace digital marketing with new value is 60,250 ringgit. Adjusted fees is 405,000 ringgit minus to 52,500 ringgit plus 68,250 ringgit equal to 420,750 ringgit. Net income is 1,452,125 ringgit minus 420,750 ringgit and equal 1,031,375 ringgit. Net income to sale ratio is 1,031,375 ringgit divided by 4,687,500 ringgit equal to 0.22. 0.22 times to 100 equal to 22%. Answer for scenario 4. Net income to sale ratio is 22%, still below 28% but strong growth. enhanced product equal higher value equal possible support future price hike.
Okay, we go to the scenario 5, which is sale force restructuring. Compare the cost effectiveness and scalability between two options. Option 1 is increase commission to 80% to boost sale by 50%. We have a sale volume increase, which is 112,500 unit, and revenue RM 2812,500, variable cost RM 1462,500, commission RM 506,215, and fixed cost we have RM 405,100 and no change. So the total cost of all RM 1462,500 variable cost, and then we plus the RM 506,215, which is commission, and then we plus RM 405,100 ringgit fees, and then we plus all of them, and then we get RM 2303,515, and then we go to the next profit, which is 200, which is RM 2812,500. We deduct RM 2373,715, and we get RM 438,715, and then net income to sale ratio RM 438,715 or RM 2000 to RM 2812,500. In this percentage, 15%. And then we go to the number 2, which is replace agent with in-house sale staff. 8 staff times RM 170 ringgit per month salary, and for percent commission to boost sale by 70%. We good, and we have a salary, commission, fixed cost, and total cost. For salary, which is we have 183,200, and then commission 127,500, fixed cost 568,200, and then total cost, which is 353,200. For the net profit is 834,300. The net income is 3187,500, and the percent of the total is 28.18%. And then from a recommendation, compare the cost effectiveness and scalability between two options. In this option A and option 2, we know that the best option is in-house sales staff, which is option B, because higher profit, higher ratio, and long-term control.